Last question, a fun one, I hope. Have you started watching Landman yet? I haven't watched it, but my X feed is full of uh, b- video clips of Billy
Yeah,
Bob Thornton lecturing people on oil prices and the fossil fuel industry in North America.
I have not been a watcher of Yellowstone or any of the Taylor Sheridan shows, but this one is pretty soapy and it's pretty cheesy, but it's fun.
Just looking over at the screen, it looks like Brent's flirting with $81 a barrel. Really, this is the highest price we've seen since kind of August, September timeframe of last year. And I feel like the last few times we had you on, Solly, we were really talking much more about an outlook of weakening fundamentals. But it seems like the narrative seems to have flipped a little bit here at the start of the year, perhaps because of new sanctions on Russia, other factors. But you tell me.
Oil prices have had a good momentum since the beginning of the year, and you're right, the sentiment has very much shifted from a downbeat one to a much more positive one already in the first half of this month. And a couple of drivers. I mean, until even last week, when we saw these increased US sanctions on Russia, we already were looking at a market where the surplus that's been widely anticipated in the oil market might be lower than initially estimated.
Break evens, generally speaking, we're talking $40, give or take, in North America. It varies slightly amongst the individual shale basins, and we carry some of that data on BI oils, I believe, on the terminal. But by and large, we're talking about $40 a barrel. So we're still, at levels here where these guys can make plenty of money.
This idea that the UAE is planning to develop the solar plus battery storage project that is going to be, I believe, if I understand, 13 times larger than the current largest project. Very interesting things happening in the renewable space, even in the part of the world you're currently residing in. So I would get a sense, I want to do a vibe check with you. Good morning, good afternoon, everyone. This is the BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On today's call, we've got two regulars, Salih Yilmaz joining from his usual perch in Dubai, then swinging across the Atlantic. We've got Scott Levine joining from our New York City headquarters at 731 Lexington Avenue. Uh, it's This is our first time having both of you on for 2025, and I want to start out with what's going on with the commodity outlook. So, just looking over at the screen, it looks like Brent's flirting with $81 a barrel. Really, this is the highest price we've seen since kind of August, September timeframe of last year. And I feel like the last few times we had you on, Solly, we were really talking much more about an outlook of weakening fundamentals. But it seems like the narrative seems to have flipped a little bit here at the start of the year, perhaps because of new sanctions on Russia, other factors. But you tell me, what's going on with the oil price, and really how should folks be thinking about it for 1Q and the remainder of 2025?
Sure. Thanks, Rob, and it's great to be back on the call. Happy New Year to everyone. So yes, I mean it's been. I mean, oil prices have had a good momentum since the beginning of the year, and you're right, the sentiment has very much shifted from a downbeat one to a much more positive one already in the first half of this month. And a couple of drivers. I mean, until even last week, when we saw these increased US sanctions on Russia, we already were looking at a market where the surplus that's been widely anticipated in the oil market might be lower than initially estimated. And last time I was on here, the numbers that we were talking about, and a couple of reasons for that. One was a relatively cold winter in the northern hemisphere, and another one was now 7 weeks straight decline in stockpiles in the US. And on top of these, the biggest driver, as you alluded to, was these new package of sanctions by the US on Russia. And we were talking about sanctions very much for this year. Under the second Trump administration, we were very much expecting stricter sanctions on Iran or simply stricter enforcement of sanctions on Iran. But generally, the market thought that however much barrels we lose from Iran, OPEC Plus would have the spare capacity to fill it. So there wasn't a huge concern around the supply disruption from Iran. But what we saw with these increased sanctions on Russia really brings a more immediate risk of supply constraint, because this, I think, was the toughest sanctions on Russia that we've seen yet. It is directly targeting two big, not the biggest exporters, but I think number 3 and number 4 exporters of oil in Russia, that's Surgutnaftgaz and Gazprom Neft. And combined, they export very close to 1 million barrels per day. I mean, it's still not clear if all of these exports would be disrupted, but they will be at risk. And that's one part of these renewed sanctions. These increased sanctions, will also target other insurers and tanker operators as well. So all combined, this is bringing another layer of supply disruption. And combined with the cold weather and combined with the decline in US stockpiles, this has really formed a big upside catalyst, a list of upside catalysts for oil prices, and that's why we've seen this jump in oil prices. So, I mean, we will continue to watch, I think, what happens with sanctions, both on Russia and Iran. How much disruption that actually causes in the physical market will be very important to watch. And of course, with Trump coming in again, the Trump trade that we've been talking about, the tariffs, meaning less global trade, meaning potentially less oil demand, is still very much in play. We'll be watching that. Also, the tariffs could apparently include Canadian oil. So this will be one of the drivers to watch as well. Stronger dollar. The market seems to think that the dollar might strengthen with Trump in power again. And of course, the relationship between the dollar and oil prices are not very steady, are a little bit unstable, but generally, very much stronger dollar can mean lower oil prices. And then, of course, what happens with domestic production in the US? Obviously, Trump has a pro-fossil fuel stance. But we don't really think, at least for crude oil production, that's going to make a huge impact. But if it's going to make any impact, it's going to be a positive one, and that could be a headwind for oil prices as well. So I think I've taken way too much time, but that's generally what's happened since the beginning of this year, and some of the drivers that we're watching into the next quarter and the rest of this year.
Okay, thank you so much, Salih. Scott, let's bring you into the conversation. Salih was talking about sanctions and Russia for a moment there. I believe some of your companies have exposure there. Give us a sense, is that something that's driving some of the narrative for some of the companies you look after? And I'm also curious to just get your pulse on the commodity landscape generally.
Sure. So firstly on Russia, just as a reminder, right after the initial sanctions, we saw really two different sets of strategies employed by the major oilfield service companies. Baker Hughes and Halliburton sold their Russian operations to local management, so they're out of Russia. Schlumberger and Weatherford, on the other hand, while committing not to grow their operations or footprint, they do remain in Russia and continue to comply with the sanctions. And we did see an article yesterday suggesting that a couple of congressmen are planning to push Schlumberger in particular to exit Russia on the back of this recent announcement. And they report on Friday, so it'll be interesting to see if they have anything to say regarding whether this impacts their plans for the region. certainly reasonable to think that that will come up in the Q&A, and that they should be prepared. That question, Russia has not been a source of growth for either of these companies the last few years, and has probably been a source of scrutiny for both of them. Frankly, it's no more, I think, than 5% of revenue for each company, but they are both still there, and will both have to, answer for that. So something to watch clearly as we move towards earnings season. And then, secondly, with regard to the implications of this recent increase in oil and gas prices, I wouldn't expect it to have an impact on the initial guidance that the majors provide for 2025. In a recap, we're probably looking at something like a mid-single-digit decline in upstream capex in North America, and something similar to the upside in terms of growth, maybe low to mid-single-digit growth in international markets. I would probably suggest that gas might be a more likely source of upside than oil in terms of the implications for the rig count and drilling. And to be clear, we haven't seen any improvement in the rig count or the frac count recently, including sizable declines last week. But we have seen for a longer period of time an increase in gas prices, and a more substantial one than we've seen in oil. And bear in mind that gas is maybe 20 to 25% of the rig count at most. So clearly pales in importance to oil, but certainly not bad news, and I would argue probably good news, particularly for North America drilling activity, and suggest that maybe we'll see some growth in the rig count this year after, call it, a 25% decline peak to trough from 2022 to the end of 2024 in the Baker Hughes tally. So I think maybe it's certainly not likely to influence guidance, but some cause for optimism. We're seeing that in the early moves in the stocks here to start the year.
Just to help frame the oil price and gas price, can you give us a sense of basically the capital efficiency? You mentioned perhaps a pullback. What do break-evens look like these days? I get the sense that every year the industry gets better and better extracting more oil, more gas molecules with less capital. But give me a sense of where we are right now with that.
Yeah, we look at the EIA puts out a monthly drilling productivity report, and we can see what the productivity looks like from new wells, and we're still moving up the curve, but probably moving up the curve at a slower rate. So the second derivative is getting weaker. Break evens, generally speaking, we're talking $40, give or take, in North America. It varies slightly amongst the individual shale basins, and we carry some of that data on BI Oils, I believe, on the terminal. But by and large, we're talking about $40 a barrel. So we're still, at levels here where these guys can make plenty of money in the oil patch drilling new wells. What's been lacking, I think, is confidence in the spot price, given all the bad news that we've seen in the macro. And clearly that drumbeat got louder in the second half of last year. All you were hearing was was bad news regarding the macro, right? And it's amazing how much the tone and sentiment has shifted within a very short period of time here. But I think you're looking at like $40 a barrel, give or take, in shale patch on average. And in offshore, you're looking at something maybe closer to 60, I think, on average, as a rough approximation. So we're still at levels, I think, where folks can generally make money. There's just that lack of conviction in the amid the volatility and the downbeat macro, but clearly the tone has firmed up here to start this year. And maybe one last thing I'd mention, there has been a divergence, Rob, sorry, with the productivity has continued to increase growth. We have seen growth in production in the shale pass the last couple of years while the rig count has gone down. Rig count went down 20% in 2023, and production grew like maybe 11%. I forget where we came in last year. I think it was more like low to mid-single digit growth in production or thereabouts, against a 5% decline in the rig count. So that you can chalk up to efficiencies. So those continue, but they're continuing at a slower rate.
Very fascinating. Just quick question on, you mentioned tone, and I also note that you referred to Schlumberger as OFS, oil field services. Now, I feel like the vibe for a while had been moving towards calling these companies energy service companies, and it's perhaps instead of oil field service companies. What's your read these days? Are you an energy service analyst or an oil field service analyst?
Yeah, so I think that probably reached its apex in 2021, before the banner year for oil in 2022, and kind of the sentiment towards ESG was kind of at its peak as well. And to be clear, I am the energy and industrial services analyst for BI, but in my work, I tend to refer to as OFS just because I feel like that acronym is kind of the standard industry standard. It doesn't reflect the change in sentiment in any way towards the group. I think the pendulum has shifted a bit back towards the traditional oil and gas moniker. And I would argue as well that with Biden leaving office here in a week and Trump entering, and potentially looking at Chris Wright as the energy secretary, that pendulum will continue to swing in that direction. But I am still, to be clear, the energy services analyst for BI, and no plans to change that.
All right, thanks a lot, Scott. There are two questions in the chat, and I just want to address them quickly. So one's on LNG, and I'll just flag next week we've got Talon Custer, Patricio Alvarez, and Vince Piazza joining. A little bit more LNG focus. So I'm going to table sort of a deep LNG question for next time. We also have a question in the chat on the Constellation Calpine deal. So one, I'd recommend go check out Nikki Sue and Gabriela Privatera's react on the deal. So just load up the ticker, type BICO, and you'll find it right there. And I will flag that we're having them on in the very near future, so that'll be a good conversation to go sort of deeper into utility land. But I think there's a lot of interesting things going on there around the themes of AI and gas. So very happy to address that at a future date. Salih, I want to come back to you now and just flag, okay, so we've got the incoming Trump administration. You already discussed this idea that maybe we're going to see tariffs ratcheting up, even possibly 25% tariffs against Canada. I still don't think folks have quite got their head wrapped around what that might mean for the energy complex in North America. But how are folks generally in the sort of large oil producing countries, regions thinking about the change in the political landscape in the U.S.? What impact do you think that's going to really have on markets as you think about 2025?
I mean, the big one that comes to mind is how it might impact the OPEC plus strategy, I think. And my immediate response would be that it shouldn't right away, but looking at the history of the first Trump administration, we know that Trump was very vocal about, in a couple of instances, I think in 2018, which was when he was asking the group to increase production, and then in 2020 when he was asking them to reduce output. So I think going forward, what I would expect, and very likely these countries are expecting, these countries within the OPEC Plus group would expect a more active involvement from Trump, asking them to essentially change their strategy. The way this could unfold, I think, is especially if we go to something like a maximum pressure type of policy against Iran, where, as I mentioned before, 1 to 1.2 million barrels per day could be at risk. I think that's when Trump could push the rest of OPEC Plus to fill that gap. It's unclear what Trump's stance will be on Russian sanctions. I mean, our first read on that is that they don't really look very reversible, so it's very unlikely that Trump would immediately reverse them. It could probably be a negotiation tool when he tries to get involved in the Russia-Ukraine talks as well. But yeah, I mean, thinking about what the countries might be thinking about, I mean, just thinking about this region in the Gulf, all the OPEC plus producers, I think, are probably getting ready to, have the U.S. president be a little bit more vocal and a little bit more involved in their strategy. But that being said, when I look at the rest of the first quarter and what's going on now with the renewed Russian sanctions, it's very unlikely. I think the reason why the market reacted and oil prices jumped is that, yes, even in the most extreme case scenario where maybe we lose 1 million barrels per day from Iran, we lose another million barrels per day from Russia, OPEC Plus currently has more than 6 million barrels per day of spare capacity. So that could easily be compensated by the rest of OPEC Plus. But I think OPEC Plus would be very strategic about that. I mean, they are currently scheduled to increase their output in April. They don't have another full meeting until May 28th. And higher prices generally, as you know, are better for them. And they've been fighting for higher prices for a while now. So unless we see a major spike in prices, which, so far what we've seen is a jump in prices, but not necessarily a huge spike, I suspect they would be very cautious and they would be slow in responding to that type of disruption. And I think they would kind of let this period of higher oil prices run to bolster their revenue.
Salih, I want to noodle a little bit more on a sort of general view of the landscape under the second Trump administration. So, we've got a number of questions in the chat kind of related to sanctions. Will Trump stick with the Biden sanctions on Russia, and how to think about that? And I think you had already sort of hit on that a little bit. But I'm also curious because you've got an interesting note out from just the other day, talking that really looks closely at the fundamentals. So kind of supply demand balance.
Yeah.
I think your core scenario previously had basically an oversupplied market in 1Q. It potentially flips to a deficit based on kind of how to think about these sanctions. So it seems like it's pretty fundamental. But I also want to just gauge your pulse on some of the secular trends. We had on Nathan Dean last week. He's our senior policy analyst based in Washington, D.C. And he was talking about sort of some of the things that the Trump administration is probably going to do, how tax reform might get into it. And he mentioned this idea that the U.S. EV tax credit, he thought that was pretty vulnerable, had a sense that it's probably going to go away. So, what's going on with EVs and demand? How's that feeding into your analysis as well?
Yeah, I mean, when we talk about EVs, I think last year, and when we talk about EVs and demand, I think what we missed, and I think a lot of the rest of the street missed, was how much Chinese oil demand might underwhelm. And I think part of the reason for Chinese oil demand to underwhelm was because of a very rapid adoption of EVs in the country. The US probably not as much, so I don't know how much impact that would have from the US, but it's definitely something to watch. I mean, I think, and the IEA report was out earlier today as well, and they are expecting marginal oil demand growth for this year to be about where it was last year, and they once again in their report are mentioning faltering demand growth in China, and they do mention once again the increased adoption of EVs in the country. So that's definitely something to watch. And I'm forgetting the other part of your question now. What
No,
was
it's
it?
okay. I mean, look, at the
Yeah.
end of the day, there have been a number of headlines about China hitting 50% of their auto market going electric this year. So it's going to be very interesting, and be curious to see how that feeds into some of the U.S. narrative as well. Maybe, Scott, just bring you in on the policy stuff as well. I know Wall Street Journal was just reporting yesterday this idea that the incoming Trump administration is going to try to unleash domestic oil and gas production. I call me a bit skeptical, but what's your sense? I mean, is there really much that can be done? Is it possible we're going to see the U.S. oil and gas patch grow output at a sort of rapid pace in 2025 or 2026 if you get the regulatory framing correct, or is it going to be more of a steady year in your view?
Yeah, I think it's more the latter. I agree with your take. I mean, the reality here is that it's economics that are going to drive production, drilling, completion activity in general, and it's more sensitive to macro factors than policy. There are things you can do around the edges to facilitate that, and I know that Chris Wright, the proposed energy secretary, was on the Hill and is, going through his process and is making positive commentary, to a similar effect. Yes, they can, they can undo some of the restrictions Biden placed on offshore drilling on federal land, and they can relax some of the permitting restrictions around LNG exports, things of that nature, and those do matter and help on the margin, but only on the margin, I think. The reality at the end of the day is the price of oil and the price of gas that's going to dictate for the most part the activity levels in the shale patch, and all the talk in the world isn't going to really change that to any significant extent. And so, no, I kind of fall into the latter camp. I think that the policy side will have more of an impact when it comes to cleaner energy technologies, as we talked about in the past, right? And we did see the Biden's finalization of the hydrogen PTC, and those were a little bit more liberal, lacked some of the standards around the 3 pillars to qualify for that, and created a pathway for nuclear and carbon capture. So those are the things I think that are probably more significant swing factors as far as policy is concerned from this incoming administration. But as far as oil and gas production is concerned, no, I think it's probably more smoke than fire.
Okay, Salih, I want to shift gears a little bit. So first of all, just thanks for everyone asking the questions. If we don't get to all of them, we'll try. We're happy to follow up with you afterwards. But Salih, there was a fascinating piece that our colleagues at Bloomberg News put out, I believe yesterday or day before, talking about this idea that the UAE is planning to develop the solar plus battery storage projects that is going to be, I believe, if I understand, 13 times larger than the current largest project. Very interesting things happening in the renewable space, even in the part of the world you're currently residing in. So I would get a sense. I want to do a vibe check with you. When you think about 2025, and you're having lots of conversations in the region, you cover a number of the companies there. How do you think about something like this? I mean, that's a massive number. So UAE is clearly perhaps really kind of maybe making some big strides into the clean energy and the energy transition this year. But I want to get your sense. What do you make of that?
Yeah, I mean, I think it makes a lot of sense. Over the last couple of years on this call, in many instances, we talked about how, especially solar is a big opportunity for this region. The sun is predictable, it's abundant. Of course, there is the issue of dust, but I think that's very much solvable. And I think it was more of a matter of priority. And obviously, this part of the world is oil and gas producing part of the world. And whenever we were talking about companies, I mean, companies like Saudi Aramco in Saudi Arabia, ADNOC here in the UAE, these were, I mean, compared to some of the global majors, especially the European ones, these were companies that were still very much focused on increasing their upstream production, very much showing confidence in continued growth in oil demand. But, they have been vocal about, in the last couple of years, diversifying away from the core business. Again, within renewables, we knew solar was going to be very important for them. We know they have very early stage investments in things like hydrogen too. And then I should say in the UAE, it generally, there is the tendency to build and construct the biggest of everything. As you know, the tallest building in the world is also here. So I saw that announcement, and the fact that it was going to be the biggest battery-linked solar project wasn't really a huge surprise to me. So just in general, I think it's in line with what we were expecting. It's not a surprise that it's very big, and it's not a surprise that it's focusing on solar and linking it with batteries. And by the way, it was Abu Dhabi Sustainability Week this week, and usually when there are these big events, usually that's where you see a lot of the big announcements coming from these companies in this region.
Salih, I know you've got a hard stop, so let me just give you one last question, just kind of on this general theme. Hydrogen, big part of the narrative often for some of the traditional oil and gas companies when they think about energy transition. Is any of that solar or deployment in the region going to run electrolyzers to produce hydrogen? I believe that's been talked about with some of the projects related to NEOM there in Saudi Arabia, but give me a sense.
Exactly. I mean, as far as I know, the fully green hydrogen electrolyzer project is the one that's, I believe, being constructed in NEOM right now. Most of the rest of the conversation has been around blue hydrogen. Generally in the region, there's been a shift to trying to produce a lot more natural gas, a lot more non-associated gas. And of course, that's partly to be used domestically so that there's more oil freed up to be exported, which is the most lucrative part of the business for them. But also, I think some of it is going to be earmarked for blue hydrogen projects as well. But again, these are, I think, relatively early stage discussions. Solar was a little bit more advanced, and clearly it's going ahead. More projects are going ahead, as evidenced by this announcement that we saw from the UAE earlier this week.
Okay, thank you so much, Salih. Scott, I want to come back to you for a couple of last comments, kind of thinking about the U.S. landscape. So I'm going to bring it back to Nathan again. When he was on last week, we did spend some time talking about a couple esoteric provisions within the Inflation Reduction Act and whether they may be safe or not safe as you think about tax reform. By Salih. And so one of the ideas that we talked about is so 45X is a manufacturing tax credit. There's this other one called 45V, which relates to hydrogen. And so I want to get a sense from you, how is hydrogen a thing that your companies are really focused on? If 45V stays, doesn't stay, do you have a sense of its relative importance to how folks in the upstream oil patch in North America, kind of thinking about how hydrogen plays into their energy transition plans?
Yeah, it's a good question. So yes, I think that we've put something out on during the election cycle. We put a lot of content out, obviously, on this topic, and I was surprised to see as much confidence in hydrogen and also carbon capture, maybe that they would maybe do a little better than expected in the Trump administration. And so yes, I think is the answer to your question. We are seeing and it's not just the pure play clean tech hydrogen names like Plug Power that we're talking about, but also the majors, the super majors, have investment plans in that area. Saudi Aramco, Exxon Mobil, and the like. And the oil field service companies, they're dabbling in it, right, from a technology standpoint. But there's still a commitment there. And if we do indeed get more liberal regs for the production tax credit, that would augur well, for hydrogen in general. But what's been missing and what's really missing from the equation is the demand side, right? Without demand, there's no market. And you can have all the, incentives for supply and projects and demos and the like, right? But if there's no demand for green hydrogen, and the demand driver is really decarbonization of these hard to abate sectors. And what drives that, right? Teeth and commitments behind some of those emissions requirements. And so until we see that develop, I think the long-term thesis is still pretty uncertain. But incrementally from a policy standpoint, I think we're encouraged by what we've seen.
Thanks so much, Scott. Last question, a fun one, I hope. Have you started watching Landman yet? I haven't watched it, but my X feed is full of video clips of Billy Bob Thornton lecturing people on oil prices and the fossil fuel industry in North America. I'm curious, is it on your watch list? Have you given it a shot yet?
I have seen 4 episodes, I'm proud to say, including one this week, and I've been itching to contribute here in the IB chat. But let me say, I don't watch a lot of TV shows. I watch movies. My wife watches a lot of TV and very few movies. And I've seen 4 episodes. I have not been a watcher of Yellowstone or any of the Taylor Sheridan shows. But this one is pretty soapy and it's pretty cheesy, but it's fun. I am definitely a fan. I'm going to stick with it, and I don't watch many shows. I could probably count on one hand the number of shows, and I'm looking forward to the White Lotus coming back next month. But anything with Billy Bob Thornton in it, I'm a fan of. It's got John Hamm. Still waiting to see if Demi Moore's going to be in it. I think she's supposed to be in it, and hasn't yet. It's pretty soapy, but I'm a fan of it. Yeah.
Fantastic. Well, I have not given it a shot yet, but I think it's on my list. And big Taylor Sheridan fan. He's got a he's got a great touch on many things. So I'll be curious. Even if I disagree with some of his views, he's a great thinker and a great sort of creator of content. So anyway, for anyone listening, let us know what you think about Landman. We'll keep our ears open. Just a quick bit of marketing. So couple of things to flag. For the last call this month, we've got a special external guest joining this call. So we've got David Bellman. I've known David for over 20 years, and he's going to join. One of his current jobs is he's working with a company called SynMax that uses satellite data to try to help folks interpret what's going on in the energy landscape. So we're going to have an interesting conversation about using geospatial data. Last call of the month. First call next month, Feb 5th. We've got Jeff Osborne and John Miller from TD Cowen joining to talk about their outlook for energy transition, politics of the second Trump administration, all the same kind of stuff that we often hit on these calls. And then maybe just last but not least, at the end of next month, Feb 26th, Feb 27th, I'm going to be in Miami for a couple of other reasons, and we're going to put together a small roundtable. Mike McGlone and I will be there, maybe a couple others. So if you are in Miami or fancy being in Miami at the end of February, give me a shout. We're happy to include you on what we'll be doing there. So until next week, take care, and please be in touch if you have any follow-up questions or comments. Scott, you look like you might want to say something
one
else.
last plug really quickly. We have a pressure pumping webinar next Tuesday at 11 a.m. with Matt Johnson, founder of Primary Vision. We carry their data on the terminal, and it should be really timely with Halliburton reporting the next day. So, join us at 11 a.m. if you can. We'll circulate the registration link, which you can also find on the terminal as well on BI Serve. So, would love to have you for that as well.
Thanks a lot. So, as a follow-up email, we'll make sure to share all the links for these upcoming events. So if they're not on your radar, you can register and join. Thanks a lot, Scott. Take care, everyone.